By listening to this episode, Loan to Cost Meaning, published in ADAS Investment Magazine, you will be fully familiar with tips for improving your LTC ratio and discuss the impact it can have on loan terms and interest rates. Welcome to Got In Early, a podcast about investing in financial markets such as cryptocurrency, the Forex, and the stock market. In the world of real estate financing, loan to cost, LTC, is a crucial metric used by investors, developers, and lenders to assess the risk associated with a project and determine the maximum loan amount that a lender is willing to provide. Simply put, LTC is the ratio of the loan amount to the total project cost. For example, if a developer is seeking a $1 million loan to finance a $2 million project, the LTC ratio would be 50%, $1 million loan, $2 million total project cost x 100. Understanding LTC is essential for anyone looking to finance a real estate project. This comprehensive guide will break down the definition of LTC, how it's calculated, and the components that make up the ratio. We'll also compare LTC to loan to value, LTV, and explain the factors that can affect LTC ratios. Finally, we'll provide tips for improving your LTC ratio and discuss the impact it can have on loan terms and interest rates. By the end of this guide, you'll have a thorough understanding of LTC and how it can help you make informed borrowing decisions. What is loan to cost, LTC? Loan to cost, LTC, is a fancy term that people use in the world of real estate financing to figure out how much money they can borrow to fund a project. To understand what loan to cost means, you need to know what a ratio is. A ratio is just a way of comparing two things to each other. In the case of LTC, we're comparing the amount of money a developer wants to borrow, that's the loan amount, to the total cost of the project they want to fund. To calculate the LTC ratio, we divide the loan amount by the total project cost and multiply the result by 100. For example, if a developer wants to borrow $1 million to fund a project that will cost $2 million in total, the LTC ratio would be 50%, $1 million loan amount, $2 million total project cost x 100. LTC is important because it helps lenders figure out how risky a project is. If a developer is asking for a loan that covers most of the project cost, that's a riskier investment for the lender. In contrast, if the developer is putting in a lot of their own money, the lender feels more secure about the investment. LTC is also important for developers because it helps them figure out how much equity they need to contribute to the project. Equity is the money that the developer puts into the project themselves, instead of borrowing it from a lender. By understanding the LTC ratio, developers can calculate how much equity they need to invest in the project to get the loan amount they need. In summary, loan to cost, LTC, is a ratio that compares the loan amount to the total project cost. It's used to help lenders understand the risk associated with a project and to help developers figure out how much equity they need to contribute. Understanding the components of LTC. To understand loan to cost, LTC, better, it's important to know the different components that make up the ratio. The first component is the loan amount, which is the amount of money the developer wants to borrow to fund their project. The loan amount can vary depending on the lender's requirements and the project's scope. The second component is the total project cost, which is the sum of all the expenses associated with the project. This includes costs like materials, labor, permits, and fees. Developers must have a clear idea of the total project cost before applying for a loan. The third component is the equity requirement, which is the amount of money that the developer needs to invest in the project themselves. Equity is the difference between the total project cost and the loan amount. In other words, it's the amount of money that the developer needs to contribute to the project, on top of the loan amount, to make the project financially viable. It's important to note that LTC is different from loan to value, LTV, which is another ratio that's commonly used in real estate financing. LTV compares the loan amount to the appraised value of the property, while LTC compares the loan amount to the total project cost. In summary, the components of LTC include the loan amount, total project cost, and equity requirement. Developers must understand these components to calculate the LTC ratio, which is a crucial factor in determining loan eligibility. By understanding LTC, Developers can determine how much equity they need to invest and how much money they can borrow for their projects. Loan to cost versus loan to value. Loan to cost, LTC, and loan to value, LTV, are two ratios that are commonly used in real estate financing. While both ratios are important, they have different applications and interpretations. LTC compares the loan amount to the total project cost, while LTV compares the loan amount to the appraised value of the property. This means that LTV takes into account the market value of the property, whereas LTC only considers the cost of the project. For example, if a developer wants to borrow $1 million to fund a project that will cost $2 million in total, and the appraised value of the property is $3 million, the LTV ratio would be 33%, $1 million loan amount, $3 million property value x 100. In contrast, the LTC ratio would be 50%, $1 million loan amount, $2 million total project cost x 100. The main difference between LTC and LTV is that LTV is more focused on the property's value, while LTC is more focused on the project's cost. This means that LTV is typically used to assess the risk of the loan, while LTC is used to determine the maximum loan amount that can be borrowed. While both ratios are important in real estate financing, they have different applications and interpretations. LTV is more focused on the property's value, while LTC is more focused on the project's cost. By understanding the differences between these two ratios, developers can make informed borrowing decisions and assess the risk associated with their project. Factors affecting LTC ratios. Loan to cost, LTC, ratios can be affected by various factors that determine the risk and feasibility of the project. Some of the key factors that can impact LTC ratios include market conditions. Market conditions such as interest rates, supply and demand, and economic growth can impact the feasibility of the project. If the market is unfavorable, it may increase the risk associated with the project and lenders may require a lower LTC ratio. Lenders' risk appetite. Different lenders have different risk appetites and may require different LTC ratios based on their internal policies and guidelines. For example, a conservative lender may require a lower LTC ratio to minimize its risk exposure, while a more aggressive lender may be willing to provide a higher LTC ratio to attract borrowers. Borrower's creditworthiness. A borrower's creditworthiness, including their credit score, income, and financial history, can impact the LTC ratio they can qualify for. A borrower with a strong credit profile may be able to secure a higher LTC ratio than someone with a weaker credit profile. Overall, LTC ratios are impacted by a combination of external factors such as market conditions, as well as internal factors such as the lender's risk appetite and the borrower's creditworthiness. By understanding these factors, borrowers can better prepare themselves for the borrowing process and increase their chances of securing favorable loan terms. How LTC affects financing decisions. Loan to cost, LTC, ratios have a significant impact on financing decisions in real estate projects. Understanding how LTC affects financing decisions is crucial for investors and developers. Importance of LTC in determining loan eligibility. LTC is a crucial factor in determining loan eligibility. Lenders use the LTC ratio to assess the level of risk associated with a project. A lower LTC ratio indicates a lower level of risk, which makes it easier to secure financing. Conversely, a higher LTC ratio indicates a higher level of risk, which may make it more difficult to secure financing. Impact on loan terms and interest rates. LTC ratios can also impact loan terms and interest rates. A lower LTC ratio may result in more favorable loan terms, such as a lower interest rate, longer loan term, or lower fees. In contrast, a higher LTC ratio may result in less favorable loan terms, such as a higher interest rate, shorter loan terms, or higher fees. Tips for improving your LTC ratio. If you're a borrower looking to improve your loan to cost, LTC, ratio, there are several strategies you can use to do so. These strategies involve increasing equity contribution, reducing project costs, and improving creditworthiness. Increasing equity contribution. One way to improve your LTC ratio is to increase the amount of money you contribute to the project up front. This means putting more of your own money into the project and borrowing less. By doing so, you reduce the overall amount you need to borrow and lower your LTC ratio. Reducing project costs. Another way to improve your LTC ratio is to find ways to minimize project costs. This can involve negotiating lower construction costs, sourcing cheaper materials, or finding more efficient ways to complete the project. By reducing costs, you can lower the total project cost and, in turn, lower your LTC ratio. Improving creditworthiness. Improving your creditworthiness is also important for improving your LTC ratio. This involves building a strong credit profile by making timely payments and minimizing debt. Lenders are more likely to offer favorable loan terms to borrowers with good credit, which can help lower your LTC ratio. Overall, improving your LTC ratio involves a combination of these strategies. By increasing equity contribution, reducing project costs, and improving creditworthiness, borrowers can improve their chances of securing favorable loan terms and successfully completing their real estate projects. Key takeaways. Loan-to-cost, LTC, is an important factor in determining loan eligibility and loan terms for real estate projects. LTC is a ratio that measures the amount of a loan compared to the total project cost, including the borrower's equity contribution. LTC is different from loan-to-value, LTV, which only measures the loan amount compared to the appraised value of the property. Several factors can affect the LTC ratio, including market conditions, lenders' risk appetite, and borrowers' creditworthiness. Improving your LTC ratio can involve increasing equity contribution, reducing project costs, and improving creditworthiness. Understanding LTC is important for making informed borrowing decisions and successfully completing real estate projects. By following these key takeaways, borrowers can navigate the lending process with greater confidence and maximize their chances of success. Conclusion. Loan-to-cost, LTC, is an important concept that all real estate investors and developers should understand. It is a ratio that measures the amount of a loan compared to the total cost of a project, including the borrower's equity contribution. LTC is crucial in determining loan eligibility and loan terms for real estate projects. The higher the LTC ratio, the higher the risk for lenders, which can result in higher interest rates or loan denial. By understanding the components of LTC, including loan amount, total project cost, and equity requirement, borrowers can take steps to improve their LTC ratio and increase their chances of securing financing on favorable terms. Factors such as market conditions, lenders' risk appetite, and borrowers' creditworthiness can all affect the LTC ratio, making it important for borrowers to consider these factors when planning their projects. In summary, understanding LTC is critical to making informed borrowing decisions and successfully completing real estate projects. By optimizing their LTC ratio and demonstrating creditworthiness, borrowers can maximize their chances of securing financing on favorable terms and achieving their real estate investment goals. In the end, we hope that by listening to this podcast you will be fully immersed in what you were looking for. You can help us improve by sharing this podcast, which is published in a DOS investment magazine, and help optimize it by submitting your comments.